Hey, this is Kyle with KyleSeagraves.com. In this video, we're going to cover the complete guide to home buying closing costs. And I mean complete. We're going to take a deep dive into this whole mystery of closing costs and everything that goes into buying a house in terms of how much you actually have to bring to the closing table. Okay, so here's the big problem that you might run into, and you might already have run into this. Number one, the whole world of closing costs and all the fees that are charged with closing on a deal can be really confusing. And then number two, what a lot of lenders do is they take advantage of the fact that fees can be kind of hidden in a whole midst of other documents, and they can charge extra fees. So if you're going to make sure that you're purchasing as the best decision, the best investment possible for you, you really need to know what's going into your fees. So here in a second, what I'm going to do is I'm going to walk through line by line two different real life examples from loan estimates that I've sent to clients of mine. I'm going to show you one loan estimate for Ohio on a FHA deal and another loan estimate for Tennessee with a conventional deal. So let's back up for a second. What's a loan estimate? A loan estimate is the document that's going to detail every single term and cost and fee that goes into your loan. It really is the document that sets up how your loan is going to be structured when you're buying a house. So the federal government requires that you receive a loan estimate 3 days after you receive a contract on an accepted offer. So the document that I'm going to show you will look the same no matter what lender you're working with. And what I do with all of my clients is I go through a personalized video review of their loan estimate line by line so they understand everything very clearly up front so they're comfortable with the loan that they're going to be getting into. Because there's no point in getting under contract and going through the whole process and then closing, and then all of a sudden you have surprise fees that you didn't know were there, or you have a monthly payment that you weren't expecting. So I try to prevent that by making sure that my clients know the numbers up front, and I want the same for you. I don't want you to run into surprise fees or things that you didn't know that were going to happen, because honestly, it's a little terrifying to think that I run into a lot of clients who were working with other lenders that they started to not like anymore, and they switched over to me. And I would ask them questions about how much were you looking at putting down? What was your monthly payment? What was your rate with this lender? And they have no clue. And so what ends up happening is they get to the closing table and they say, I can't believe this lender raised fees on me. I can't believe my monthly payment is this. They told me it was going to be this. So the loan estimate and knowing it back and forth is going to help you out a lot. It's going to help you be able to negotiate the best loan, the best rates, the best terms for you as well. Okay, so again, we're going to dive into two examples. We're going to do an Ohio loan that is an FHA loan and a Tennessee loan that's a conventional, so you can see differences between two states and differences between two loans and how they're kind of documented. That way you can get a good grasp. So this video might be a little bit longer, but it's going to be pretty in-depth. I'll give you some time codes in the comments so you can jump around to either the Ohio FHA or the Tennessee conventional if you want to look at those different states. All right, so let's go ahead and get to the loan estimate walkthrough. All right, here we are with the first loan estimate. This is for Ohio with an FHA loan. Something that I've also noticed halfway through this video is I am super pale and I need to get a little bit of a tan. These yellow lights don't help me out very much. But this loan estimate is a loan estimate that I sent to a client of mine. And I'm going to give you a walkthrough of exactly what I gave to him to show him all the terms and details of his loan. And I'm going to hang out in the bottom corner here for you so I'm not too much in the way. So let me expand this just a touch more if my computer's going to let me. There we go. All right, so you're going to get a document that looks like this. It's going to say loan estimate at the top. Your lender is going to be listed up here. I went ahead and hid some things for some privacy of our client. So your lender is going to be listed up here. We broker loans, so I put them through a specific lender. It's going to show you obviously who's applying. So this is going to be your name, your address here, and the property that you're purchasing as well. So this is in New Carlisle, Ohio. It's going to show you your purchase price. You've probably already seen this from the contract you signed with your real estate agent. Also up here, it's going to show you your loan term. So are you taking a 30-year loan? You taking a 15-year, 20-year, 18-year if you want to get a little wild? It's going to be your loan term here. It's also going to show you your purchase, or I'm sorry, your purpose. Your purpose is the purchase. So is this going to be a purchase? Is this going to be a rate and term refinance? Is this going to be a cash out refinance? That's going to be listed here. Also your product, this is important. is it going to be a fixed rate? Is it going to be an adjustable? You want to know how your loan is going to look over a long time period. So make sure that if you want a fixed rate, that it says fixed rate here, and that you're not getting kind of put into an adjustable rate mortgage that's going to change in the future. Also, your loan type is going to be listed here. So whether you're going conventional, we're going FHA, VA, or other, this might be a USDA loan or a portfolio loan here. Also, you'll have a loan ID number. This is so the lender can keep track of which loan is which, and a rate lock. So your rate lock is basically kind of telling you what your rate is doing until you close. So rates can either be locked or floating. So if your rate's floating, it means that it's moving with the market until it's locked. And if it's locked, it's going to stay in one place the entire time. So then once you close, then what happens is you default to the product up here. So let's say, right now we're locked, and then once this person closes, he's going to have a fixed rate. Okay. So if it says no rate lock, you can still have a fixed rate loan. It just means that it's floating until you lock the rate. So some of the benefits there on locking versus not locking is your lender might be able to help you get, time the market to get the best rate possible. Okay. So then you also have your loan amount. It's listed very closely to your purchase price here. So we can see for this person, it's $255, $290. And then over here, it lists, can this amount increase after closing? Big old no, which is awesome. Interest rate, he has a 3.99%. Can this increase after closing? No. Monthly principal and interest. Okay, this is going to show him what he's going to pay in monthly principal and interest. So it's $1,217.32, and it cannot increase after closing. Prepayment penalty. This means, can you prepay into the equity of the loan with any costs or fees? And there is no penalty here, which is wonderful. And a balloon payment. A balloon payment is basically where you have your loan for a certain term, and then the entire portion is due after a specific number of years. And for most loans, it's not the case. Those used to be the case a couple of years ago, but they're not so much anymore. These are what are called risky features. So if your loan says yes to any of these, you might want to talk with your loan officer about them. We don't do any loans with risky features like that just because they are risky and kind of dangerous for our clients. So we make sure that they do not exist for these loans. All right, down here we have projected payments. So you can see a payment calculation. We can see in years 1 through 30, so the entire duration of the loan, this person is going to be paying principal and interest of $1,217.32, mortgage insurance for FHA of $176 per month, and estimated escrow. So this is his taxes and insurance for $384 per month. That gives him an estimated total monthly payment of $1,777 per month. And then again, $384 a month in taxes and insurance in the escrow account. All right, so now let's go down here to closing cost details. This is what you came for. Complete guide to closing costs. In section A here, this is origination charges. So these are the fees and costs that are in direct correlation with your lender. So section A is going to be your lender's fees. Okay, so if you're going to see fees charged by your lender, it's here. For this specific loan, we didn't charge any fees. There was no underwriting fee, no points, nothing like that here for this borrower. So that's great for him, but this is where you want to check for what your lender is charging you. Okay, in section B, these are going to be services you can't shop for. So these are services that are required, but it doesn't mean that your lender is charging them. They're most likely charged by a third party, but they're going to be required to close on your loan, and you don't get to shop them around. Okay, so for an example, you have an appraisal fee here. That's $500. That's paid to an appraiser. A credit report fee, that's going to be paid to a credit report company. Flood certification and this MERS fee, this is like a back-end technology fee, are going to be paid to most likely a company like CoreLogic to be able to handle that. This is FHA's upfront mortgage insurance premium. So something kind of strange about the way FHA works is they have upfront mortgage insurance put into their loan amount. So this isn't a fee being charged at closing. This is a fee put into the loan amount charged by FHA. So we'll get to that here in a second. And then tax service fee, again, this is something that would be charged by CoreLogic or another third-party company. Down here in section C, this is what our borrower would expect for title costs. So title costs are basically paying for a title company to do a search of the title of the property. So who's owned the property over a period of time. And they're going to make sure that when you sign at the closing table that you're the sole owner of that property. They're making sure that nobody else has a claim to that property. For example, we just closed on a deal a month ago, and the title company did a search and found there was an extra $100,000 mortgage on the property that was recorded incorrectly. So that means if the buyer closed it without going through a title company, then they would have been on the line for an extra $100,000 from some other person from 1992. So title companies protect you from that. They help you spot those errors, they correct those errors for you, and make sure that the title is clean for you, and then they'll insure the title of the property as well. All right, so up here in section E, this is where we'll see taxes and other government fees. So these are normally going to be recorded or charged by the state or the county. So for instance, this county charged a recording fee of about $316 here. All right, Ohio has no transfer taxes, so he didn't have to pay anything here. In section F, this is your prepaids. So this is where you're prepaying specific items of the deal. So for instance, getting a mortgage, you're going to pay 12 months of homeowner's insurance up front. So for the 12 months for him, this is $1,080 here. And then you'll also be paying prepaid interest. So we can see he paid $27.91 per day for 15 days at 3.99% is $419. So prepaid interest is the interest that's calculated from the time that you close until your first payment is due. And the reason prepaid interest is collected is because there's always a month gap between when you close and when your first payment is due. So the lender wants to collect that interest for that time period. So you don't have to make a full mortgage payment in that month because you have the prepaid interest. Okay? And then in section G, this is where your escrow account is getting set up. So the escrow account is taking bigger payments and breaking them down into small monthly chunks. Kind of think of it like a Netflix subscription for your taxes and insurance. So all the convenience of Netflix with none of the fun because it's paying taxes and it's paying insurance. So for instance, homeowner's insurance is usually paid annually. Well, if everybody paid annually, then they would have these big lump sum payments for, in this instance, $1,000 annually. Sometimes people aren't great at budgeting for that. So escrow helps you take that $1,080 and break it down into, instead of $1,080, just pay $90 per month added to your mortgage payment. And then what you do is the escrow account helps you set up a little bit of a cushion so that you always have money left in there in case insurance or taxes increase, or in case you're behind on a payment, your mortgage and taxes are always current. Okay, so in the escrow account, we collected 3 months of homeowner's insurance and about 5 months of property taxes. In section H, this is where you're going to find other fees that don't fit into these categories. So for instance, the realtor on this deal had a transaction fee that they charge for $495. And also the buyer had an option to purchase owner's title insurance. You can see this was optional for them. And this protects them in the future. It basically insures the title from the title company, saying, in case the title company made a mistake, then this insurance policy protects them against that error. Okay. Then we can come down here. You can actually see that we gave this buyer a lender credit. So we gave them money here towards their closing costs. We gave them $1,080 to help bring down their closing costs here. Okay. And then what you do is you take everything and you calculate your cash to close. So the total cash due at closing. So we would take our total closing costs. Then we would take the down payment. Something that you'll notice here, and this can be listed different ways, but here we go. The mortgage insurance upfront premium was actually taken out of the down payment. And I'll show you how this works here. It's a little tricky, but since this is an FHA loan, there was a required minimum 3.5% down payment. So that down payment minimum is actually $9,100. So instead of having $9,100 listed here, the way this is listed on the loan estimate, and sometimes it's a little bit different, but that this upfront mortgage insurance premium was taken out of the down payment funds. So the buyer's still bringing the minimum down payment. It's just listed in a slightly different way. Okay, the buyer also put down an earnest money deposit of $2,500 and negotiated $0 in seller credits. So you can get seller credits when you negotiate your offer. So when you put in an offer, talk with your realtor about the possibility of seller credits. That's where you get some money paid by the seller to pay down some of your closing costs. Okay, and then the buyer also got a credit for some tax proration. Since taxes are paid semi-annually, he got a credit for some of the taxes during the time that the seller was in the property. And then that gives him his estimated cash to close, so his bottom line number was $11,932. So something that you'll notice is that, the struggle here with loan estimates is since the lender is the one that has to give it to you, it can feel like the lender is charging all of these costs. But if you looked here, all of these sections, we charged 0 fees. We actually gave our buyer a credit here of $1,000. So more than not charging anything, we gave them a credit. So make sure that you kind of do a detailed look at what are these fees, are they required, and who are they being paid to? That way you can get a better understanding of, are there things that you can shop for or negotiate in your deal as well? So talk with your loan officer about that. Then if we scroll down to this third page of the loan estimate here, it's going to tell us a little bit more detail about some of the terms of the loan. It's going to show us some comparisons. So in 5 years, this is the amount paid in principal, interest, mortgage insurance, and loan costs. And this is the amount of principal that's been paid off. So in 5 years, this buyer will have paid off about almost closer to $24,000. The APR, so this is the costs of the loan term expressed as a rate. So this is kind of a mixture of all of the financing charges here with all of the costs and fees. And then the total interest percentage. So this is the total amount of interest that you'll pay over the loan term as a percentage of your loan amount. Okay, this also shows a couple more details, things about your appraisal, if your loan can be assumed by someone else, homeowners insurance requirements, what a late payment charge will be, refinancing and what that will look like, and then the servicing of the loan, so who's going to accept payments. Okay, so that is about it for the Ohio FHA deal. We went in pretty detailed here. On the next one, when we go through Tennessee on the conventional loan, I'm going to jump through things a little bit quicker. We won't have to go as in-depth since you know a lot here. We'll just talk about some differences on the Tennessee deal. So that's coming up next. All right, here we are with the Tennessee deal with the conventional loan. We're not going to go as in-depth. We're just going to kind of do another high-level view of the loan estimate, as well as talking through maybe some differences from what we saw from the FHA deal in Ohio. So again, everything's pretty similar. The document looks exactly the same, showing us our loan estimate here. The property's in Murfreesboro, Tennessee. We have a purchase price of $196. Okay. The loan term is 30 years on a purchase, a fixed rate conventional loan. And you'll notice here, the rate lock is not there yet. It's floating. So when I did this deal, I sent it to them and floated the rate so that I can get better market timing to get them a better interest rate. And so somewhere along before we closed, I locked that deal. That way they had a fixed rate for the life of their loan. Okay, so we can see they had a loan amount here of $166,600, an interest rate of 4.375%, a monthly principal and interest payment of $831.81 per month. No dangerous features here on their loan. Something different here from the last deal. The last deal only had a time period of year 1 to year 30. Now, what's different here is that this is split into different terms. And the reason why is because mortgage insurance actually dropped off here. So we can see their principal and interest is the same throughout the entire duration of the loan. Their escrow, so their taxes and insurance, are the same for the entire duration. But in years 1 through 5, they have mortgage insurance of $21 since they put less than 20% down. Then in year 6, they hit 20% equity and that $21 fell off. And we can see that reflected in the estimated total monthly payment as well. Okay, we can also see their taxes and insurance of $189 a month here in the escrow account. All right, if we get to closing cost details, we can see Section A, charged by us, the lender. We had an underwriting fee for this deal of $995. Okay, similar to the other deal, we had an appraisal fee, a credit report fee, a flood certification, and a tax service fee. Something that's not listed here is any mortgage insurance, because conventional doesn't have upfront mortgage insurance. It only has monthly mortgage insurance. So something to note there. I actually have a video on conventional versus FHA that I'll put here at the top of the video if you want to look into some of the differences there and the mortgage insurance as well. Okay, in Section C here again, this is what we estimated the title company would charge. In Section E, they had a recording fee to the county. But something a little bit different than the Ohio deal is that Tennessee has transfer taxes where Ohio doesn't. So in Ohio, the seller pays the transfer taxes. In Tennessee, the buyer pays the transfer taxes. So something to keep in mind there is understanding if your state charges transfer taxes to the buyer or the seller. Okay, here's their prepaids. They had homeowners insurance listed here, that prepaid interest as well. Their escrow account was also set up, about 3 months of homeowners insurance and 6 months of property taxes. And the amount of months vary based on when you're closing during the year. We have a calculator that helps us make sure we have all of the money we need in the escrow account, so that might change depending on when you're closing. Okay, in Section H, we can see that this person's buyer, or this person's realtor, had a broker fee charged for $150 here. There was also a transfer fee charged by the Homeowners Association Company for $250. And then they also had an optional owner's title policy for $166. And you can see in this example as well, we gave them a credit of $1,056 as well. And then we can do the same thing as we're calculating the cash to close, and this is a little bit different than the other deal. So we have total closing costs, then we add on the down payment, so we can see our buyer brought a good down payment here. They also contributed an earnest money deposit. So the earnest money deposit is something that you would pay up front when you accept the offer. And this shows a seller that kind of you mean business, that you really want to close the deal, that you're willing to put money up front and put it at stake, saying that you're going to be bound to this contract and you put some monetary value behind it as well. Okay, the seller was contributing $1,500 here, so that's a credit that they received. And then they got a tax proration credit for $900. And that gave them their estimated cash to close of $32,068. Okay, so if we scroll down to page 3, again, this shows them some more details about their loan and some of the financing costs, some other details about payments, refinance, and servicing. And then they had the chance to sign the receipt here as well. So I hope this gives you a good idea of closing costs. We covered a lot. I know this is a long video. If you made it so far, thanks so much for watching. But really, the more that you understand the terms and the costs and the fees going into your loan, the better you're going to be at making a judgment call on, is this a good loan or is it not? Or are there ways that you can decrease some of your closing costs or change the terms of your loan so that they fit you better? Ultimately, the mortgage advisor you're working with should be showing you all of this information up front and not hiding anything in a whole slew of a bunch of other disclosures. Okay, so if you haven't seen your loan estimate and you're under contract, ask for it. Make sure that somebody walks through that line by line with you so you're comfortable and understand everything that's happening. Well, thanks so much for watching this video. I hope this added some clarity to the loan estimate. If you have any questions about loan estimates or costs or terms of loans, let me know in the comments. Also, if you like this video, leave me a like or subscribe to see more videos, and I'll see you on the next one. Thanks.